All right, everyone, let's do a quick sound check. Let me know if you can hear me. Adam, Alfredo, Bern, Bill, Bob, Bruce, Charles, everybody. Good morning. It's a Friday. As a reminder, there's a holiday on Monday. So remember, usually on a 3-day weekend, the market is not the same because traders begin to leave the market as the weekend goes underway. And so we're going to have a little bit different environment this morning, which is good. I always believe that you have to understand both the good and the bad aspects of trading. So if everyone could just do me a favor and give me a quick sound check before we begin. We'll go over a few different methods. I'll answer your questions. Whatever you want to look at, I'm happy to look at as well. All right, Sally, thank you. Bern. All right, very good. So to begin, let's understand that trading is not for everybody. It's risky, so please make sure that you understand the risks of trading. It's not for everyone. Talk to your broker, ask questions, and please don't trade with funds you can't afford to lose. Just a disclaimer on the risks of trading, whether it's Forex, futures, stocks, whatever type of trading you want to do. Okay, so to begin, I want to make sure everyone here in the room has NinjaTrader or has a charting platform, or if you're absolutely new, please let me know if you're an absolutely beginner, new trader, because I do help you and provide you with NinjaTrader to start you off, and that way you have an opportunity to actually get your hands dirty to start off instead of just jumping into it. So if anyone needs NinjaTrader or isn't a beginner, you can always email support@DayTradeToWin.com and we can assist you with getting that set up. All right, so a lot of people here are NinjaTrader, fantastic. Now you don't have to raise your hand if you have any questions. You can go ahead and just type your questions away and I will be taking a look at the chat box, the questions and answers, and I'll answer the questions that are relevant. If there are any questions after, you can always email support@DayTradeToWin.com and I'm happy to answer your questions. And also, I have here someone that will answer, and which his name is Chad. He will be able to answer your questions. If it's something that I'm showing you, he can probably answer it quicker than me typing away. Okay, so he is here. Alfredo, if you need NinjaTrader, just send an email to support@daytradetowin.com and we'll help you get set up with it. Okay? All right, so to begin, I'm going to start off here that as a 3-day weekend, we have to treat the day a little bit differently. You're going to see the environment not being exactly the same. And that's normal. So whenever you have a half a day or you have a 3-day weekend, please expect it to be a little bit different in the type of activity. It's not going to be the same as a Monday or a Tuesday as a regular day. The other thing I want you to focus on is volatility. And volatility can sometimes be interpreted in different ways. So when I look at volatility, many of you already know because I have hundreds of videos on the internet, whether it be on YouTube or Vimeo, or even on the Day Trade to Win blog, which is very popular, showing you how I use volatility to help me understand the current conditions. So I know some of you may already know this. Hey, Holly. I am new looking at the candle chart. Can I follow along? Yeah, you can. Go ahead. We should have the same exact data and information. Just remember, I'm Eastern Standard Time Zone. If you're in a different time zone in the world, your candles will look the same, but the time will be different. So if you're in California, it'll say 6:30. If you're in Australia, it may say 23:30. So the candles are the same. You can definitely follow along, and you can follow up with any questions you have. So when I think about volatility, you have to understand that the market as a whole is always changing. And a lot of people attempt to have very specific stops and targets. And so when I think about the market, realize that you're interpreting what you're seeing and what's occurring, which makes a target or a stop relevant to the conditions. So if I see the current market and I say to myself, I want to have right here and right now, if I go long or go short, I want to have a very specific target or stop. how do you know that the market can first be able to achieve it? And second of all, how is it going to be interpreted as a continuation, or it's not going to be able to be made? And a stop is very important, obviously. If you have a stop too tight based on the current conditions, how do you know it's too large of a stop, or how do you know it's too tight of a stop? So what I want to do is I want to be able to understand the conditions. When I look at the market as a whole, I think of the last four candles and the activity that we have just seen. So I'm going to add here the ATR with a setting of 4. Now, for some of you who do not have a charting platform or who don't have NinjaTrader, it's very simple. You're just opening up a chart, you're right-clicking on the chart, and you're adding an indicator, which is already included with most charting platforms, is the ATR, and you're setting it to a setting of 4. So when you first add this, it'll say 14, but you're adding it to a setting of 4. And when I do that, you have a graph here on the bottom that basically indicates the last four candles, on average, what was the market able to do? And it's a relationship of volatility. So if I look at the last four candles and I see, for example, completed candles, that is, and I see this, I immediately know, based on the average of what the market has just done, what I can expect moving forward into the future. It's not a tick or two ticks, and it's definitely not 10 points or 20 points. It's only 1 3/4 of a point, or even if I'm a little bit more conservative, 1.5 points. Every tick, which is the smallest increment that this market could move, is 1/4 of a point. It's related to as 0.25. So if it's 1/4 of a point, it's 0.25, 0.50, 0.75, and you can see that too. You see that there? So on the scale here on the right, it's indicating the smallest increment, which is called a tick or a pip. And in the E-mini market, which is a great market to trade, it's 1/4 of a point. So 1.74, if I round down, would be considered 6 ticks or 1.5. Okay, so now the candle has closed 5 minutes, and now it's going to look at the last four candles, which is indicating that the current conditions happen to be now 2 points. So if I took a trade, I don't expect 10 points or 20 points. I definitely don't expect the market to only move 2 or 3 ticks. It's going to be equivalent to 2 points, which is what it's currently trading at, the volatility and what it's doing. So if you put yourself in a mind frame of how do I know that the market could actually move and the market could actually make this distance, I don't have any question about what I believe it could do. It's 2 points, so my stop cannot be smaller than 2 points. My target should be 2 points, or maybe even what I call front running or 1 tick shy, which would be 1 3/4 or 7 ticks. And that way I know that as a whole, the market could either make a 2-point move or it could go further than that, but I can't expect at least a 2-point move on the current condition. So this is very important, and a lot of traders fail to realize that things are always changing. You can't trade the same way slow as you can when the market is fast. So that's the first thing. The second thing is a couple of tips here that I like to look at as a trader would be never knowing when a candle closes and opens is not a benefit. You have to know when a candle closes and when a candle opens, and it prepares you. So right now, this candle is plotting. How do I know if there's 2 minutes left, 3 minutes left, 4 minutes left? It's very simple. We can look at the bar timer, which is an indicator included. It's a tool, but it's an indicator in NinjaTrader. It's free as well, and you should be adding that to your chart. Now in NinjaTrader, there are a few different indicators, all of which I think are useless. Unfortunately, moving averages and MACDs, they're always late in telling you what to do. So we can't really rely on indicators, but we can rely on the bar timer as a tool and the ATR, as you see it here, as a tool to help me identify the current conditions. Anyone have any questions for me? Everybody okay with that? Now, if you're using a different trading platform, I know some of you like TradeStation. I also offer a few free tools here that I think everybody could use. So the first thing is if you go here to the home page and you go to software and free downloads, you're going to see here a couple of free downloads that everybody can utilize as much as you want. First, you have a news indicator. I think this is important because you can take a look at news when it appears live as a live alert right on your chart. So I offer this free. You just have to download it and you'll be able to download that and know when you have high priority news events around the world. The other thing you can download, and this is available now for NinjaTrader 8 as well as NinjaTrader 7. The other thing I have here is an online news calendar. If you prefer, you can just have a web page, and the web page allows for you actually have a separate page with the news live as well, instead of it being an indicator. The other option here is a bar timer for TradeStation. If you use TradeStation, I know that TradeStation for a long time did not have a bar timer, so I have one here for download for free, and a tick counter as well. And you have here a very handy tool called Karen's Time Sync, which I have here available for anyone to download. It is actually a tool that syncs your computer clock and makes sure that you're on par with the rest of the world, because a few seconds do make a difference, and if your computer clock is slow or fast and compared to the rest of the world, when that candle closes for you, it may be different for your neighbor or for me or for somebody else. So at least you know that your computer clock is synced with the world time. So that way everybody's on the same page, and that's important. So I have here a couple of tools. And the other thing here while I'm on this here, don't forget about the blog. I always add videos, I add lots of free information here on the blog. The latest post here is just the group mentorship class, which is almost filled for February 20th, which is Monday. Even though Monday's a holiday, I'll still have the first class here on Monday. If you're interested, don't forget to sign up. Call me if you have any questions, email me, and you can download what's included with the group mentorship, which is everything. Atlas Line, ATO, Roadmap, price action scalping, trade scalper, all with lifetime licenses as well as lifetime software and support. So this is a few things I wanted to cover. So don't forget to check out the DayTradeToWin homepage, the blog, the software. So now when I go back here to the chart, the current conditions, as you can see, are still 2 points. So again, what is my expectation? The market could move 2 points up or 2 points down. And if you take a look, let me just expand here the chart a little bit. If you take a look at what the market did from this high to this low, that's 2.25 points. That is right on par with the expectation that I had when for the last 4 candles told me expect 2 points. The market went 2.25. The same thing, we're still at 2 points. I can almost guarantee that this candle from high to low will be at least 2 points, or 1 3/4 of a point, or 2.25, but it's not going to be normally 5 points or 10 points or 1 point. It's going to be roughly 2 points. And like I said, this is important because now you have an expectation. What's my stop? What's my target? What's my anticipation of what the market can do? All right, let's see here. Let me see here on the calculator bar. Yeah, but Trader Dude, if you put here that if you add that as false, right? So your question is, if I put on the calculate on bar as false, this candle, right? Because you're not calculating when this candle closes, you're calculating it as it's occurring. It's not going to work the same way. So your question is very good, because if I'm looking at these 4 candles, this last candle has not finished. So you have 3 candles that have completed. This 4th candle is only maybe a point instead of, what it's supposed to be when it closes, which is in actuality how it calculates. So you have 3 candles that are finished with their full values, and this one is not finished and it doesn't have a full value. So the calculation is wrong. You have to wait until 4 candles completely close for this to update, or else what you're seeing here is a value that is incorrect. No, you got it, Bill. Let me know if you have any questions. Okay? So just a few things here that I wanted to mention here. Any other questions? Everybody okay with that so far? Okay, now bar timer, ATR, let's talk a little bit about price action. Now, if you look at the market and you see these wicks, I call them yo-yo bars. And the yo-yo bars, these candles with wicks, you may not think too much of them, but I have to tell you, they are very important. When you see, for example, a candle with a wick like this, or like this, or like this, this is telling me that something internally is changing. Don't dismiss it. I know that we have wicks everywhere, and it's not just one wick, here or there that's going to make a difference. When you see these candles that are what I call them yo-yo bars with the wicks, it may be that the market is hitting support or resistance, and it's telling you that something internally is stopping the market from going lower or from going higher, and the market may be changing. Now, it doesn't mean it's going to reverse. It just may mean for the moment it's pausing and it's having a hard time continuing. So if you realize the market's in a trend up or trend down, remember, these are all things that I teach uh, in most of my classes, how to identify a trend and so on. But if you understand that there's a trend and you start seeing these yo-yo bars or these candles with wicks in the direction of the trend, think about what that is telling you. It's telling you that as the market begins to move up, that it's trying to, let's say, go beyond resistance, and it's having a hard time. And the sellers are beginning to stop it and stop it and stop it and stop it and stop it. So what you're going to see is this idea of the market trying to continue in the trend up, can't continue because the sellers are there, and it gets thrown or pushed back down. What you have is a candle with a wick. Now, like I said, one wick, here or there, how are you really going to make heads or tails of it? You can't. That's the truth. But you have to look at a grouping of yo-yo bars in the similar area or similar pricing. Let's say they don't have to be consecutive, but they do have to be at similar pricing. And that really does change the narrative because it's telling you that things are happening over and over. Remember, every candle is 5 minutes. It's happening over and over, and it's failing to move higher. So if I see a group of yo-yo bars or candles with wicks in the same direction that the trend is trying to continue, but it's beginning to stop, pay attention because it doesn't mean reversal. It just means for the moment, if I try to go long thinking it's going to go and continue, I'm not going to have a very good result because it's already proven that it's trying and failing, trying and failing. So 2, 3, 4 of these yo-yo bars. I'm going to show you some examples, definitely. So let me show you some examples to show you what I mean. And these are all just tips, not necessarily specific entries or specific targets. That is more of an in-depth education on trading. It's just pay attention if you're short or you're long and this is happening. It's time to get out. It's time to tighten up your stop. It's time to realize that the market is in trouble. So for example, let me see if I can find here a solid example to show you. We can definitely take a look at February, no problem. So look at this here. This is just a very easy to see example. I think everybody would agree that the market is going down. Now, I don't know here that the market's going to stop. I would assume it is because large candles typically don't convert into continuation. But if I see this here, many people will say, I'm going to short it. So let's say you go short. and the next candle stops and reverses. And it may not be a cause for concern, and the market turns around a little bit but starts to come down, and then the market tries again to continue lower but fails to go much further beyond where it's already been, and you have there another attempt. But before you go any further, take a look at what it's telling you. The market came to a certain place and stopped. Whatever price this is, let's say it's 23.37 or 23.38. The next time that it tried, you see that there's a wick which is larger than the body that tried to continue and say, I'm going to continue going short, but it immediately got pushed back up. Then you have another candle that did the same exact thing, went down a little bit lower, but couldn't sustain itself and got pushed right back up. Now, I'm not using any fancy indicators. I'm not looking at moving averages or anything whatsoever. I'm just understanding price action. This is telling me that the buyers are now thinking of overpowering the sellers. Maybe this is a cheap opportunity to buy. Maybe it's time to take a profit. Maybe they were selling. It's time to buy it back at a profit. Now what you're seeing is multiple attempts after a trend of failing to continue. And the yo-yo bars or the wicks are always a heads up or a leading indication that things for the moment are changing. So don't dismiss it. If you are short and you see not just one candle, but you see multiple or groupings of candles doing the same thing, pay attention and start either tightening up or getting out or putting a target or a stop that doesn't hurt you from where we are right now, because the result was that. Now, it's not that it's always going to reverse. It could definitely continue lower, but at least for the moment I know the market is in trouble to this downside. And the same thing if you look at an uptrend, and let me see if I can find a good example also to show you here. This would be just trying to find, and well, I see another to the short side. So you see here to the short side that it reached a point where it tried and failed, and then tried to go lower and failed, and then it did it a third time, a fourth time, a fifth time, a sixth time. I mean, how much evidence do you have to say at the same general area, whether it's long-term support from something in the past, whether it's a Fibonacci of that number, whether it's whatever you're looking at, it doesn't matter. We're just identifying price action. Use it to your advantage and say, I'm trying to go lower, but I can't because the buyers are overpowering the sellers. And the result is that. So at least you have a good concept of, should I, tighten up my trailing stop? Should I get out of this trade? Because you're seeing it happen. So wicks larger than normal in the direction of the market trending, pay attention. Everybody okay with that? Mike, Mace, Kevin, George, Jorge, TJ, Ron, Sally, let me know if everybody's clear on that. Just simple price action methodologies that don't make your chart look like a circus event. And I'm trying to avoid adding all these crazy things to the chart. Actually, the Atlas line is something that I'm going to add now to the chart because right here. All right, so here as we are, here as we speak is the Atlas line for today, right now. It's telling me short. So if I go short, remember how I was mentioning the ATR as an important factor to realize whether or not I should take 5 points, 4 points, 10 points, what's my stop? Well, right away, I can identify the current conditions as 2 1/4 of a point. So if I'm going to take a profit, it has to be around this number. So if I look at 2 1/4 points, 2 points, this is what the result is. So I'm thinking ahead, not shooting by the hip. Here is where the market should go. This is my target. Even if you have it a tick in front of it, it's called front running when you put it a tick in front like that, which would be 2 points instead of 2 1/4. It's still an area where I believe the market will move. So pay attention to it. you're not going to see a large move. You're going to see and expect the first thing to happen is this. Now, after this happens, you may expect the market to trail or to continue. How do you know whether or not the market will give you an opportunity to trail a stop? Well, for those of you who are thinking, how do you trail a stop? Or how do you take more profit than just what you're seeing here? There are ways to do that, but we have to plan it right. So the first thing you have to do is say, when does the market trend? Or when does the market actually give you more of an opportunity? Well, it's not when the market is slow. When markets are slow, they don't trend. When markets are slow, they chop around, they gap. There's a lot of whipsaw and channel and doji. So you can't really expect larger moves where you can trail a stop under those conditions. But you can take a larger target if the market is more volatile. So even though I believe that this here, based on the current conditions, is what it could do, only after the market makes this move, if the conditions are higher or more volatile, I would say at least 2.5 points, 3 points, then you could say the market's in a good movement, a good momentum, I can take a little bit more profit. Not, again, 20 points, but take it in increments. 1 times the ATR, 2 times the ATR, 3 times the ATR. And that way, you're always in check. You're not, shooting for the stars. You're being realistic on what the expectation happens to be. Okay? So if the ATR and the volatility are higher, so this should be, I think, a little bit closer to 3 points, 2.5, 2 3/4. It's just good, solid movement. Once it hits the first 1 times the ATR, let me just write this down here, 1 times the ATR, expect the market to move and continue beyond that. But if it comes back to where you entered, there's no need for you to hold on to that any longer. It's time to get out of the trade. There's a few certain trailing stop methods that I teach. Check the blog, type in or search trailing stops. You're going to see a few videos on how I like to trail a stop. Okay, very good. Okay, next, let's talk a little bit about February. As February comes around, I'll leave this up here. I'm just going to switch to a daily chart. We talk a little bit about how the year is going to continue, how the year is going to be evolving. Well, if I go to a daily chart here, let's have a good example. Let me just remove here this. Let's have a good example of what to expect. I think everyone could agree, big run, big trend. January was an up month. I call it the January effect. Please review the previous webinars that I've had on the January effect, which indicates that the month closed higher than where it opened. January closed higher, higher month. Now the market continued higher. Fantastic, right? So now what? Wait until the market turns around. Wait until the market actually gives you 4, 5, 6 days of retracement. It will happen. It always does. Because we have a January month higher than close, meaning the market's going to be higher for the year, you don't want to always buy at the highs. You want to buy when it pulls back and then continues back up. So timing is everything. Wait until we have 4, 5, 6 days, just solid retracement days, not chopping around. And then when you see, let's say, for example, the market beginning to do this, slowly going down a couple of days, and then it stops, and then it starts to climb back up, this is your opportunity to go long. The goal is to go long to test where the market has been. The market has been to these highs. So let's use a tool. I know it's going to be funny for you guys to hear me say Fibonacci retracement tool without the Fibonacci numbers. This is what I'm looking at. When this turns around and begins to climb back up to test where the highs have already been, this is your opportunity. As soon as it breaks 50%, you're long. your goal may be only 1 times the ATR, which it almost always does, which is in this case currently about 15 points. But that's not the point. You can expect the market to not only make the 15 or 16 or whatever points 1 times the ATR happens to be, but you can also expect the market to at least test the highs. This will happen numerous times throughout the year. And every time it happens, especially on a year with a January effect, you have a great opportunity. You don't have to bet the farm. You can trail a stop. You can get in intraday, but just realize first 5, 6, a good solid pullback. You see the market stopping. You see the market beginning to climb back up. You're long only after the market moves a few points past the midpoint or 50% marker. Now, I uncheck all the Fibonacci values, and I only use the 0, the 100, and the 50. And that way, I can update this tool with the values as you see them, not the Fibonacci values, which I don't use Fibonacci's to trade. And that way, I know when I expect the market to break this by a few points, here's my target. Here is my ultimate goal, which sometimes it doesn't make. It may miss it, but at least you have 15, 16 points, whatever the case may be, here as your first goal, your first attempt, and then you can trail it from there. Questions on this? Very good. Next, let's take a look at a few other things. Scalping, right? Scalping is something that a lot of people ask me to do, and I think scalping offers its opportunities. In the same way that I look at the ATR on a 5-minute chart, the ATR on a daily chart, just to see the reference of what the expectation is on whatever market and whatever chart you're looking at. When you look at scalping, let's go to a 1-minute chart, for example, here. And a 1-minute chart is how I like to look at scalping, because if I'm going to take a few ticks, and for example, this is on the Atlas line, a 1-minute chart. So, the Atlas line will give you similar signals, but not based off of the 5-minute. It's based off the 1-minute chart. And so it's based off of price action. You have 1, you have 2 consecutive candles closing here below the Atlas line. That's the reason for this. So whether you're looking at a 5-minute chart or 1-minute chart, it's a relationship of price action to the Atlas line. Now, if I'm going to take a target, look at these values. What can I expect when I see these values? Again, it's relative. So if you see a trade, long, short, it doesn't matter. What's the expectation? For scalping and for a smaller time frame, 1 point is 4 ticks. That's really all I can expect. I can't expect, again, 5, 10 points. It's just a point based on this chart. Again, it's relative. So what did the market do? It definitely went down a point. So wherever you are in the chart, keep your eye on the ATR to dictate what your target and, more importantly, how much stop or loss. Because if you have a stop or loss smaller than what is currently plotting, you can get knocked out or chopped out unnecessarily. When is the market too slow? On a scalping time period, I would say anything less than 2 ticks or half a point. Because in relationship, you're just looking at the market moving 1 tick up or down. Now, unless you're trading 100 contracts for 1 tick, it's not really worth the risk for a tick. Risk is very important. Overbought, oversold is very important. All these things are very important. And so when I take a look here at the market being slower than normal, it's not worth trading. And look at the relationship. The market is less than a tick, less than 2 ticks, and all you have is it chopping around. It's not important to be in this type of a market. Stay away from it and then look for something better. Okay? The market always moves up and down, and focus on it when it's above 2 ticks. Even better when it's at 3 ticks. 3 ticks is even better, because 3 ticks, it's a healthy environment on a 1-minute chart. Okay? So this would be right there, 3 ticks. And now anything above 3 ticks, I know I can take 3 ticks. So again, it's just relative. It's not a mystery. It's just market's fast, I realize it. Market's too slow to trade, I realize it. Market's normal, I realize it. So don't overcomplicate it. Hey Kamal, good to see you, good to hear from you. Aliceline is more of a day trading tool, Burn, so I would not recommend it as a daily chart or on a daily chart. 15 minute, 5 minute, I think work the best, but it's not intended to be a swing traded or a pivotal traded type of product. It's more of a day trading product. And also, a lot of traders want to trade more, and I have to say, trade less. Trade less because um, risk, every time you place yourself into the market, it's risk. So don't trade everything and anything. Pick and choose the best opportunity to buy or to sell. Those opportunities will always be the better opportunities. Okay, that's very important. So if you're trading 100 times a day and you're seeing no result, I believe that you should be trading less, maybe 5 times a day, but being more accurate. I think, in my opinion, those are always the best moves. Because Bill, at 950 with this big move, let me just go back to the 5 minute chart here. It's not weighted, Bill, first of all, when you look at the ATR. So when you take a look here at this big move here, for example, it's not calculating the ATR solely based on this. It's always using an average of the last 4 candles. So it's using these 4 candles for this value. And then as it pushes forward, it uses now the next 4 completed candles, which you see it went up a little bit, most likely because these 2 candles are larger. Now it moves forward. These 2 candles, these 4 candles, now the market is on average a little bit slower. The same thing with these 4 candles. So you see how it works? Just because at 950 or 955 you had a large candle, it's not going to be weighted and say, let me increase the ATR because of that 1 candle. It's the average of the 4, Bill. Okay? So let me know if that makes sense. And that's why I recommend not having, there was a question about adding the, let me see here, this ATR as calculate on bar close to false. You have to have it true because you have to allow the candle to close in order to properly calculate the 4 completed candles. If you have it false, the last candle, the fourth one, is smaller, so it's going to throw off the average. Let's talk a little bit about stops. Stops are important because one stop, one hard price, it's not going to be something that is going to benefit you. You go long or you go short here, you have one hard stop. Well, what could happen with those hard stops? The hard stop you have to wait until it takes you out. You have to wait until either the target is reached. I think there's a better way to do this. A stop should not be a one category fits all type of move. It should be a grouping of stops, whichever occurs first. If you have a stop that is, let's say, 5 points or 4 points or 3 points, but yet no stop and no target is occurring for, let's say, an hour, the market is no longer doing what it was supposed to be doing, going long or going short, now, an hour later, compared to why you entered. It's a totally different dynamic. So I believe that multiple stops based off of not just a hard stop of price, but also of price, of time, and of proof are very important. When you have 3 or more stops, what you're saying is, I have a reason to go long or go short, but I also have a reason not just based off of price, but based off of multiple situations to get me out of the trade. Now, this idea of a stop does not have to be a loss. The idea of a stop could be a small win, it could be break even, it could also be a smaller loss. It doesn't always have to be a big loss. So when you think about stops, don't think about a 2 point stop on every type of trade that I take, or a 3 point stop because that's all my account can afford. Here's the way that I like to look at it. First, when you enter into the trade, you have to have a protection. I call that a catastrophic stop. And a catastrophic stop is basically a catastrophe happens, an earthquake, there's some type of terrorist attack in the world, something that Trump says makes everybody panic, whatever the case may be, and it doesn't matter. It's there to protect you. So a catastrophic stop is there to get you out at the largest or worst scenario because we don't want to have a naked position. The next thing is, what if you instead think about time? The relationship to time basically says, I want to enter and exit as fast as possible so my risk is out of the way. Because every time we enter, we have risk, which means that you should not hold on to a trade for hours on end. Limit your trade to a very small period of time. My recommendation on a 5-minute chart, it's different for every time frame, but it's relative. A catastrophic stop when you first enter to protect you. A time-based stop is some type of time. Now, I recommend 4 candles on a 5-minute chart, which is roughly about 20 minutes. There's no reason to be in the trade for more than 20 minutes. If you entered for a reason, it's not happening or it's not moving in your favor, then get out. Why am I going to hold on to this trade and hope an hour later it's going to work? I exit. It could be a small win after a time-based stop because it'd be close to the target. It could be a small loss. It could be almost the catastrophic stop. It could be break even. But I'm out of the trade. I'm looking for the next opportunity. There's also proof, and proof is very important because if you have some type of proof that says, you know, things are changing, I entered for a reason, but things are changing. I have proof that I'm no longer interested in holding out to this short position or this long position. Get out of the trade if there's proof. Now, proof comes in a variety of different methods or reasons. So a couple of reasons for proof would be the market is breaking its pivotal stop. The market is closing above or below on the opposite side of the Atlas line, or it's coming back into the blueprint range, which is part of the power price action. Or the stop could be if a news event occurs and the market breaks really hard, there's a reason or proof that I need to get out of the trade. So proof is very important. Now, use rules. Just like I use the catastrophic stop, it's determined off of the ATR. Just like I use the time based off of 4 candles, and the proof is the same thing. It has to be a concrete set of rules, either pivotal stop, it could be a close on the opposite side of the Atlas line, and so forth. So having these 3 stops minimum to help you exit a trade if it doesn't make your target will always benefit you. Because if you have, let's say, 100 trades and you break them out, and statistically you say, what is the possibilities of me making a target? What are the possibilities of me just getting flat out stopped out? And what are the possibilities of me being in a trade, but it doesn't work out, and I'm exiting sooner rather than waiting for the catastrophic stop to hit? I'll tell you, the benefit of having multiple stops is that the trades that don't work, that do not make your targets, you're going to get out on either time or on proof a majority of the time, which really limits the amount of loss that you have. Even the time-based stop doesn't have to be a loss. It could be an actual winner as well. So I want you to focus on multiple stops to get you out of the trade instead of a one hard price-based exit strategy. All right. Last but not least, I mentioned to you that yo-yo bars in the beginning of this webinar are important. How many times has the market shown me these wicks where it's trying and trying and trying? Now, I don't know the reason, right? I can probably make something up if you want. I can say it's because of this reason or Fibonacci's or long-term resistance. It doesn't matter. But I'll tell you, based on the current conditions, something is stopping it, at least for right now, from moving higher. Not to say that I won't move higher later, but if I'm currently short, here is my proof to not be short, or I should say not be long. If I'm currently long and it's trying and failing, I would recommend It's time to tighten up that stop. It's time to take profit if you have multiple positions. It's just time to realize that it's trying and it's being paused. The market's not being able to break through this. And so you have to realize that as part of price action. Does that make sense to everybody? You have to forward think as a trader and not just depend on indicators. Okay, ATR, news. Let me just add the news calendar. There's no news today, I already checked, but let me just add to you, show you what the news indicator looks like, which is, that's the ABC. And the news indicator, I think I have it on this computer. There it is, news right there. So this is, while it loads up here, news. And you can see here on the right, it says there are no pending news events for today. That's what the indicator looks like. And if I go back here in time, let me just show you the ABC method as well. So this is included in the mentorship. It's called the ABC indicator or ABC method. And this indicator is included with the program, which allows me to see if the day is normal or if the day is trending. 80% of the time, the day does not trend. 20% of the time, we have trending markets. So can I expect a trend day in and day out? The answer is no. Can I expect the market to chop around most of the time? Yes. Now, how do I know if the day is going to be a trending day? How do I know if the day is going to be more of a normal up and down movement? Very simple. This is A, this is B, and this is C. They each have a relationship to each other. This is a relationship, and this is a relationship. The A part of the day is always the strongest. Look at the volatility on the ATR. It's the highest. It is where you can see most of the action. Typically, moving forward after the first 2.5 hours, the market doesn't get more volatile. It slows down. It starts to begin to contract. And it's normal. It's completely normal. So as I go forward here in time, what's happening? The ATR and the volatility are getting smaller. You can see it diminishing from 2 points to 1.5 to 1.25, and the candles are getting smaller. So larger volatility, the ATR is larger, smaller, and tightening up. Completely normal. But what if it's not like this? What if the market is breaking above or below the A range? I call this the ABC method for a reason, because this is part A. If the candles begin to break above or below the range of A, this is again 2.5 hours. Remember, it's not rocket science, and I teach exactly how each of these methods work and are configured. No surprises and not a black box anything. It's really based off of price action. When you see the market break above or break below, you have to say to yourself, the day has a characteristic of a trending day. Only happens 20% out of the time, 20, 15% out of the year, which means counter trend trades aren't going to work, which means if I'm going to trail a stop, that's the way to go. So right after 12 o'clock, or the first 2.5 hours, 12 o'clock Eastern Standard, you can expect either normally nothing to happen 80% of the time, or a breakout, the market is trending. So this is a normal day. The same relationship between B and C, but now it's not so much a trending day, it's more of a late day rally or late day sell-off. And when the market is in a late day rally or in a late day sell-off, you can take advantage of it. Maybe FOMC starts it off. So there's different reasons, obviously, but when you take a look at a late day rally, what you're doing is realizing the candles are not contained within the B range, and they're actually breaking out. So the same relationship, is the market breaking above or breaking below the range created by 2.5 hours, 12 o'clock and 2:30 or 14:30? If the answer is yes, you have a late day rally or sell-off. If the answer is no, it's normal. look exactly how the market was unable to move lower and was held by this. And when it reached here, the day is over, but it stopped. Now you're looking at after hours. So I want to be able to take a late day rally or a sell-off earlier rather than later. I also want to be able to take or have an opportunity to see the type of day that exists. So when I look back at, for example, let's see if I can find a good day here to show you a trending day or late day rally or sell-off. Here you have A, right? First 2.5 hours outlined by the software. You have B, which is also outlined by the software. And what is happening in the B part of the day, the middle part of the day, lunchtime, as a lot of people like to refer to it, which is not exactly accurate. It's just because the market is slowing down. Whoever's long or short is just waiting. It's not because they're having lunch. I can expect, because the market is beginning to break out of the A range, that a trend for the day is forming. So take advantage of it, and you see the market continued higher. Now the software does provide to you the entries, and there's much better trades that I teach than the ABC, but essentially it's giving you a long opportunity because these candles are beginning to break out. The same thing here, these candles are beginning to break out. This now being the C part of the day, it's a late day rally. It's just confirming the trend. And so a late day rally, the market begins to give you, it's actually two consecutive candles closing. It's not just one, it's two consecutive candles closing above the range of B, or two consecutive candles closing above the range of A, which prompts the signal. And now I have a long, or I have a long, but believe it or not, this is the most important part of the day because it tells me the day is normal or the day is trending. And I can expect more normal days than I can anything else. The day is typically normal. Then, I mean, normal being it chops around, it goes up, it goes down. Can you imagine if every day was a trending day, what kind of situation we'd have? We'd have every single day being an opportunity. So when I look at the day, I prefer to see it as chopping, up, down, counter trend trades, and I instead want to look at whether or not it's different. Is it a trending day? I can't do the same type of moves that I usually do because it has to be counter trend. All right. So that's yesterday. So let's take a look at one more. So this ABC software I include in mentorship, and I think the power price action course as well. All right, so here is A. Again, no mystery, right? Highest high, lowest low of A, first 2.5 hours. In B, here's the two consecutive candles closing. The software tells me, take a look, pay attention. You may not want to fight this trend because the day is giving you a trending day aspect. This is very common of trending days. And there you have it. There's B, the most important part of the day to identify the type of day. And C, which is here, nothing. No rally, no sell-off. It was contained by this high and this low. Again, it's not rocket science. It can be simple. It just has to be focused on candles, price action, nothing fancy, and nothing with lots of colors too. You don't have to have 8 indicators on your chart with all different colors because it confuses you more than it helps. Any questions on this? Bill, you okay with this? ATO trade for the day has not happened yet. So for the moment, there's no ATO trade. Let's take a look at that. I was showing you, let me just go back to today. Okay, so what was I mentioning about the yo-yo bars? So look at the market. It tried, it tried, it tried. Now these wicks are small. You may not want to put too much stock into it, but look at this wick, look at this wick, and look at this, and look at this. Now, I'm not a fortune teller. I don't have psychic abilities. I can tell you, though, that the market, for what it's showing me, and for you as well to interpret, these yo-yo bars are talking to you. They're telling you, unable to move higher for whatever the reason, pay attention. If you're long, it's time to start tightening it up and getting out, or at least locking in some profit if you happen to be long. If you happen to be long. So I want you to pay attention to the yo-yo bars because they do indicate internally things are changing. Groupings, very important. Nice big class. Email me if you have any questions. Visit the website. Here is the website. And for those of you interested, I see there are a couple of comments on mentorship. It includes everything. Monday we start at 5 o'clock, and it's 8 weeks with me, twice a week. Atlas line roadmap, blueprint, X5, at the open, trade scalper, the price action scalping method for the E-mini, the ABC pattern, which I just showed you. It includes the software, how to filter trades, overbought, oversold, trading the news. It's a complete program. The best part about it, full support. It's all inclusive. There's nothing to buy. Even NinjaTrader 8 indicators are included. I'm updating them as we speak, and I'm going to provide all my current mentorship students as well as lifetime traders with the Atlas line, the NinjaTrader 8 indicators as well. I would say burn, I think within the next, we're in February 17th, by the end of this month, burn, I would put it highly um, suspect, and just check the website, the Trade Scalper page. It'll be available on, it'll say NinjaTrader 7, NinjaTrader 8. So I would think within the next 2 weeks. We have it, we're just testing it, making sure it's working correctly. All right, everybody, stay safe out there. Have a great weekend. Email me if you have any questions. 3-day weekend. Remember, Monday's a holiday. If you want to join, we have space available. Monday, we begin our class, and we can support and set you up with all of the programs. You don't have to install it yourself. We do remote support all the time. And NinjaTrader is a given. We provide that as well. All right, sounds good. That's right, Bob. I think I remember you were telling me you were coming down to Florida from Jersey. Excellent. You'd go have a safe trip. All right, everybody. Talk to you soon. Until the next webinar. I'm going to post this on the blog later today so you guys can review it and learn from it. Until next time, bye-bye.